As Bob Dylan would have once said, everything is a little upside down. You've got valuations varied widely across industries, while market exuberance remains, thanks in no small part to the huge influence of first-time retail traders. What our next guest goes one step further. He says there is no roadmap and that the survivors will be decided by those who know where the cheap stocks are. For more on this, we're pleased to be joined by Grant Patterson of Providence Wealth here in our Barangaroo studios. Grant, welcome to the program. It's great to have you here with us. You've brought along, I don't know if we've got it to show, but one of my favorite charts of the past couple of weeks. And that is about the S&P 500 change in market cap since the beginning of the year. So we're talking about the 5 largest cap stocks, putting on $1.6, $1.7 trillion, where the remaining 495 of the S&P 500 are down by $1.6 trillion. I don't think most people know that.
It's an incredible chart. It was a wow chart that I sent around to our investment committee when I saw it. And so I guess it begs the question about what is the index? Is it cheap or expensive when you have such huge dispersion in stocks? So there you had it, as you mentioned, Nadine, the 5 biggest stocks accounting for the 495 balance in the index. So I think it's just showing how distorted the markets are becoming. And I think from an asset allocation point of view, I've got to be very careful not to just be generalised whether a market is cheap or expensive, because it really depends on what's underneath the index level before committing to markets.
So are we wrong to constantly focus in on the index? You know, it's up by this, S&P 500 hitting a fresh record high, retreating. I mean, are indexes passé if you're looking to allocate assets in the real world?
Yeah, I think so. I think we've come to a stage, I mean, this reminds me very much of back in October 2000, where we had the huge dispersion in stocks, in the tech stocks in that period of time. And, you know, stocks fell quite heavily. Amazon fell over 90% during that period of time. Now, Amazon was a startup at that stage. But, you know, when you're seeing these sort of movements, I think, you know, I'm certainly picking up myself is saying, well, we think valuations are stretched, PEs are quite expensive, herd mentality, behavioural finance is probably got the red warning signs. But you know, the market at the moment, I think, is so distorted that by talking about an index, I think is irrelevant. And quite often at late stages of cycles, you know, you have the herd moving into index funds and passive, and the value managers get left behind. Now, the value managers have their time in the sun when the market has a difficult period of time.
Grant, do you believe there's too much extrapolation of recent outcomes driving this market high when you see those mega cap tech stocks in particular, where they're basically looking at what's been happening the past 3 or 4 months and applying that over a longer term time horizon? Do you think that's what's actually driving this herd mentality?
Yes, David. I mean, I'm not quite sure how you value a stock for the next 10 or 20 years, given the disruption that's going on at the moment, and the market's prepared to spend multiples of revenue on the view that they know what that stock's going to be doing in 10 or 20 years' time. So yes, I agree. I think the extrapolation is very dangerous, and I think we need to be very careful at this point of the cycle.
Okay, so given this point of the cycle, everything that we know about megatech, we used to call it big tech, then it was the FANGs, and now it's just megatech, and you know who we're talking about. But so where are areas of value emerging in your view? I mean, we're at the back end of US quarterly earnings season. We're getting a bit more clarity, I suppose, when it comes to the pandemic, a bit of a flattening of the curve there. So where do you look?
Well, I think we look for international equities, we look for the value managers and let them look for the stocks. I mean, here in Australia, I think, you know, things like domestic tourism, regional hospitality, you know, those sort of areas I think look quite interesting from our perspective. Obviously, there's not going to be any international travel for some time. So it's really, you know, having a look at the consumer staples, those sort of areas that should hold up pretty well, and you're not paying big multiples for those sort of stocks at this sort of level. And perversely, we actually think there's some value starting to come back into the retail property sector. So AREIT's retail been hit very hard. We know why. Rents are down quite sharply. But people will eventually go back and shop, and will go to shopping centres, and the shopping centres will have to be smart to reposition their centres to attract customers, and that may be a different sort of mix, tenant mix that they have there.
You mentioned offshore markets. We've got the US dollar is looking a little bit weak at the moment. Interest rates are rock bottom in many parts of the world. Where does that leave EM? Is that something on the radar at the moment?
Not yet. I mean, we tend to feel that we've got a lot of exposure in emerging markets by being here in Australia and our index through the resources. So we tend not to specifically allocate to emerging markets, but clearly, you know, the commodity prices are starting to tell you something. Copper has been very, very strong, and you know that's sort of indicating that perhaps, you know, we'll see a pickup of growth, and emerging markets should benefit from that. Okay,
so we have had, you know, this FOMO, this TINA, you know, many factors, stimulus, liquidity driving, I'm talking US markets in particular, higher. So when does the music stop in your view?
Don't know.
But how does it stop?
Well, look, it may be different this time, but the result will be the same. You know, valuations are very stretched. The thing that we'd be really cautious about, I mean, when you're paying such big multiples for growth stocks, your discount rate assumptions makes a big difference. And so at the moment, the discount rate, being the US government bond rate, is so low that, you know, you can argue PE infinity. What's it matter? Because you've got a discount rate so low. If that changes, that will undermine valuations sharply and significantly. And we'd be starting to just keep an eye on whether inflation, certainly not in the short term, is an issue, but longer term, is the market starting to tell us about their fears of inflation? We've had gold price up quite strongly, which we spoke about last time I was here. You've had the M2 money supply figure. My friend Jonathan Payne sent us a chart this morning that's off the charts. It's double the highest level that we've ever seen. So that's the money that's circulating in the system. You've also seen inflation-linked bonds starting to move higher. So we'd be watching that as the potential catalyst for a change in valuations.
One thing I've noticed is that a lot of people are looking at the fundamentals of the economy, and they're seeing this pickup in inflation we saw in the US CPI data that was released yesterday. And they're saying, well, economic conditions are so soft at the moment that we're going to naturally see a decline back in inflationary pressures. In fact, it may even be deflationary for a period of time. Do you think there's something maybe being missed here? Because we are still seeing the yields creep up overnight as well. I think 10 years got to like a 7-week high. Is there something that the markets maybe aren't paying enough attention to at this point?
Well, the markets are certainly discounting the issue of inflation, and well, certainly investors are discounting that. I think it would be foolish to not give it some consideration down the track. I don't think it's imminent, but these things sort of creep up on you slowly. And I can't see how inflation is going to be a problem short term. I mean, we've got asset price inflation, that's for sure. But with the amount of money that's circulating around, if that gets any velocity, what's missing is velocity. If we start seeing the velocity of money pick up, then I think it's an issue.
I was listening to a podcast earlier this week, and I hadn't sort of thought of it myself, no big surprise, but they had said that, you know, even the breakdown in global supply chains as a result of the pandemic could inspire some of an uptick of inflation as well. So there's obviously, you know, lots bubbling away there under the surface. We're out of time right now, Grant. Could you say hello to Jonathan Payne for us?
I will indeed. Thanks very much.
We're waiting for him to venture into the city. But Grant, it's been a pleasure to have you in. Thank you.
Thank you so much.
Thanks,
David.
Joining us from Providence Wealth.